What is going on, everyone, and welcome back to Explain the Charts. Today is September 29th, 2025, and we are looking at a very conflicting picture for Ethereum. The news cycle is a whirlwind of bullish and bearish signals, creating a ton of uncertainty in the market. On the bullish side, we have significant on-chain activity showing massive institutional buying. CoinGape reports that treasury companies like Bitmine and SharpLink Gaming have been scooping up hundreds of millions of dollars worth of ETH, seemingly triggered by cooling U.S. inflation data. This suggests that smart money sees these lower prices as a major buying opportunity. However, the bearish news is just as compelling. We've seen 5 straight days of spot Ether ETF outflows, indicating weakening retail and institutional participation through those vehicles. Inside Bitcoins highlighted a recent, sharp plunge below the critical $4,000 mark, which triggered a massive liquidation, costing one whale investor over $45 million. This price drop is being attributed to broader macroeconomic fears, including a potential U.S. government shutdown, which is causing widespread deleveraging across the crypto space. So we have a classic battle. Institutions accumulating directly on-chain versus fear-driven selling and ETF outflows. Let's jump into the charts to see how the story is unfolding in the price action. Looking at the daily chart, we can see the grander narrative of the past several months. We had that incredible run-up in August, peaking around $4,890, which now stands as our major long-term resistance. Following that peak, we saw a significant corrective phase throughout September. The Motley Fool article from September 22nd, which reported a 6.8% drop, can be seen right here as investors took profits near the highs. That was followed by an even more dramatic move on September 25th, this massive red candle that broke decisively below the psychological $4,000 level. This move aligns perfectly with the news of the whale liquidation and escalating macro fears. The low of that candle, around $3,832, has now established a very important short-term support level. Since that low, we've seen a few days of recovery, with buyers stepping in to reclaim the $4,000 handle. This bounce coincides with the news of Bitmine's large purchases, suggesting they were indeed buying that dip. Let's narrow our focus on the daily chart to the action since the beginning of August to get a clearer view of the current structure. You can see the ascent to the $4,890 high and the subsequent series of lower highs and lower lows, which defines a downtrend. The price consolidated for a while above $4,300, a level some analysts like Tom Lee flagged as key support. However, that support was clearly violated during the sell-off on September 25th. That broken support at $4,300 will now likely act as a major area of resistance on any move higher. The bounce from the $3,800s is encouraging for bulls, but we are still trading well below that key $4,300 pivot point. This area between roughly $3,800 and $4,300 is now a critical range. A failure to break above $4,300 could signal that this is just a relief rally before another leg down. The next significant support zones to watch below the recent lows are the demand areas around $3,500 to $3,600 and then down to $3,200, as highlighted in some technical reports. Now let's switch to the 15-minute chart to dissect the most recent price action over the last few days. Here we can see the anatomy of the crash and the recovery in high definition. This vertical drop is the liquidation event on September 25th, finding a bottom just above $3,830. What followed was a strong V-shaped recovery, quickly reclaiming $4,000. Since then, the price has been grinding upwards, establishing a clear short-term uptrend channel with a series of higher highs and higher lows. Over the past 24 hours, however, that momentum has started to wane. We are seeing consolidation and sideways price action right around the $4,000 to $4,150 level. This indicates a period of indecision in the market. Bulls and bears are fighting for control at this level, which will be pivotal for the next short-term move. A break below this consolidation range, say below $3,970, could signal that the bearish trend is resuming. Conversely, a strong push above $4,150 could give bulls the confidence to challenge that key $4,300 resistance. Alright, let's pull back to the daily chart to recap and formulate some unbiased predictions. The market is at a critical inflection point, defined by conflicting fundamental drivers and technical levels. Let's summarize the key price levels to watch. Major long-term resistance remains the August high, up near $4,900. More immediate and crucial resistance is the former support level around $4,300. The current price is hovering just below $4,150, fighting to hold its recent gains. Immediate support can be found at the psychological $4,000 mark. Below that, the recent low around $3,830 is the line in the sand for short-term bulls. If that level breaks, we look towards the major support zone between $3,200 and $3,600. So, what's next? Here's the bullish scenario, which I would place at a 60% probability in the immediate short term. The strong institutional buying pressure could overwhelm the sellers, pushing the price firmly above the current consolidation. A daily close above $4,300 would be a very strong signal, reinforcing this bullish case and opening the door for a move back towards $4,500 and higher. This scenario is supported by the narrative of a developing supercycle. Now for the bearish scenario, which I see as a 40% probability. If macroeconomic fears intensify or ETF outflows continue to accelerate, sellers could regain control. A rejection from the $4,200 to $4,300 resistance area followed by a break below $4,000 would be a major bearish confirmation. This would likely lead to a retest of the $3,830 low and potentially a deeper correction into that $3,500 to $3,600 demand zone. Things to watch for will be ETF flow data, any further news on institutional on-chain activity, and upcoming U.S. economic data. Volume will be key. Look for increasing volume on a breakout in either direction to confirm the move. That's our analysis for today. Trade safe, manage your risk, and be sure to like and subscribe to Explain the Charts for more in-depth analysis. We'll see you next time.